Hello. All members are requested to please occupy the corner seats so that it is convenient for the people who are coming late, or else I would request all the members to come and occupy the front seats so you are not disturbed.
Good evening, members, and welcome to the second day of the crash course on New Income Tax Act 2025. Yesterday, we had gone through some of the important aspects under the Income Tax Act 2025. Now, today we have two sessions. The session has been rescheduled. Actually, the second session is taken first, and first session has been shifted to second because the second session, that is the business and profession, is very vast, as you know that, and will take a lot of time. So the speaker has requested us and we have given them the permission. Before we start the session, let us raise for our institute motto.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्द्वैता 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 एतद्द्वैता.
Thank you. So today's topic is on business and professions. So member will be eager to know what are the various changes in the business and profession, whether the method of calculation of depreciation has changed or not, whether any expenses are disallowed under section 37(1) has been changed or 41AB has been changed or not. So what are the additional benefits what as a SSC we can get under the business and profession. To cater to this need of this, we have an eminent speaker, Avinash Ravani. I request our committee member, Shreyans Dedia, to briefly introduce him.
Good evening, everyone. It is my pleasure to introduce our today's first speaker, CA Avinash Ravani. He's a fellow CA and DISA holder, qualified in the year 1993 and founder of the firm Ravani and Company. His area of expertise includes direct tax advisory and compliance, stat and tax audits, company law and corporate governance, e-filing systems and digital taxation, professional training and thought leadership. His professional engagements includes member of various study circles of WIRC. He's a faculty and speaker and addressed various seminars at different forums including ICAI, BCAS, CTC and other forums. He has delivered 700 plus lectures on direct tax and company law. He is among India's first e-filers for TDS, income tax and MCA returns. He is core team member for ICAI and WRC e-filing help desk, and he has handled various committee roles at various forums. His publications includes technical guide on ITR forms, guidance note on revised tax audit reports, technical guide on easy incorporation of company, practitioner's guide to audit of small entities, guide on charges under Companies Act, LLP Act, implementation guide on tax audit changes, guidance note on tax audit under section 44AB, and more journals and publications. With this, I request all the members to welcome our today's first speaker with a huge round of applause. Request our past convener, CA Vijay Chayam, to present memento to our today's speaker. Now request Avinash sir to take the charge.
Change करो. Good evening, everybody. First of all, thank you, everyone. The entire team at BCSA, seniors, all professional colleagues. Yesterday's meeting, what it is said, that there is no changes, right? And people were happy. Even I was also happy. So today's topic, I have been told that I have to speak on profit and gains on business and profession changes, comparison between Income Tax Act 1961 and 2025. And what are the effects, changes for non-corporate SSEs. The discussion is basically a compilation of material from various sources and from where it is compiled. All details will be shared with you. The material will also be given to you, don't worry. And this material is only for the purpose of discussion. A disclaimer, pure disclaimer, that it should not be taken as a legal interpretation and not a legal entrance. Topic per se, when you say that the act has been drafted from AI or it is taken from chat GPT, etc. Now very well, most of the people have done the course of AI, right? How many people have not done till yet? Oh, too many are there. The courses are available. I am not advertising it, but I would request that you please do it. Just have a feel of it. Because in the near future, we are moving towards AI. And how this AI is going to help our profession. Because we are at such an age that neither olds are going to accept us, new one are not going to accept us, old are not leaving us, and the nightmare are increasing. Agreeing or no? But since being in the profession since last 35 years or 40 years or 50 years, because I see lot many seniors over here, now cannot leave the profession and start new things, but have to be with the profession in the last 5 or 10 years what the God has given you. You have to be with it. And the government is continuously keeping changes, coming up with the changes, and you don't adopt with the changes, you will be out of it. When 2006 e-filing was introduced, I had passed in 1993 without computer knowledge. And when I filed my first online return, I was very happy because it took almost around 8 days to file first online return. And the second return which I filed, it took only 8 minutes to file. So you have to learn. There is no other process, because when you are in the profession, you need to learn it. There is no other escapement about it. And now in the era where you are, you need to learn AI. There is you cannot run away. Now Income Tax Act 2025, what it is said, that it is just a change of sections. Let us keep aside whatever is said yesterday. Let us see what is there today. I will discuss only today what are the changes related to business and profession. You may learn, because our institute has come up with the publication. You can just refer to it. It is very short publication, available free of cost for download. You can buy it also, but free, you can download it and you can take the print. It is a short publication of 819 pages. You can read on Sundays. And we have spent almost our valuable time on writing this publication. नहीं निकलेगा 1 महीना पब्लिकेशन का. आपको जितना पढ़ना है उतना पढ़ो. जब भी आपको टाइम मिले, आपको जो भी प्रॉब्लम है उतना ही आप पढ़ो. ज़्यादा करने की ज़रूरत नहीं है, लेकिन आपको यूटिलिटीज़ भी अवेलेबल है वेबसाइट पे. आपको जितना चाहिए आप रिफ़र कर सकते हो. जब भी चाहिए आपको लॉस वगैरह भी मिल जाएगा. एंड में आई विल शेयर इट विद यू. So coming per se with the topic, that Income Tax Act, we have draft rules, draft act coming from effect from 1st April 2026. So this is the history how this Income Tax Act 2025 came it. And as a part of CA profession, we should be proud that we have been given this opportunity to be a part of drafting of the Income Tax Act. because this is the first time our institute has been involved in drafting the Income Tax Act. Our Direct Tax Committee Chairman, Piyush, was there. Our other committee members, our secretariat, they were actively involved and they have spent most of the time. And thereafter, when the representation for the rules has come, there has been continuously meeting which was going on. We had almost around 30 sessions of discussions wherein what has to be there, that is what the may and shall, etc., what was discussed yesterday, how it can be replaced, how it can be resolved. That also discussions has been going on, representation has been made, and see that is what the outcome is going to be there, because being a part of the Direct Tax Committee, when I was involved in this meeting, and the representation has been given, now let the act come, or let the rules come. Act is already notified, but let the rules come. What the rules has been coming, let us see what is there. But जब तक नई वाली नहीं आती तब तक जूनी वाली से तो काम चलाना पड़ेगा. Then original bill that is was launched, was introduced on 1st February 13th, and it became the act was passed in the Rajya Sabha on August 12th. To see the fast work which has been done, which was never been done in our history of the last 60 years. This is the commendment of the work which has been done. And one thing was there, that after the introduction of this passing of it, there has been amendment also in the last budget, which was being criticized by many persons, that why these things has happened, because while the time it was identified, there was some drafting which required the amendment. So that also has been tried to be rectified. And then draft rules has been notified. The draft rules has been, comments were given, was to be given on last February 20th was the last date. People would have got the mail that you notify, you give your comments. How many people have given the comments for that? Nobody, right? We only talk when we are at the dinner meeting, dinner table, or when we sit outside and give our comments there. But nobody would like to give the comments whenever the things are going on, right? When we have to speak, we don't speak, and otherwise we like to speak or send the comments on the WhatsApp or on the social media, where it is not required to be given. That is why our profession is dragging. So this draft rules and all comments have been given. Let us see now what the final outcome is. So select committee report, Parliament of India, 2020. This is the history of the Income Tax Act. Now coming per se, the basic principles of computing the income remains the same. There is no change in that. If you have earned the profit, you have to pay the tax. Computation everybody knows. That is, we had the sections. What we want to say, we earn, claim the expenses, and report, pay the tax. That we have been from 1961 Act, 1922 Act, 1961 Act, all remains the same. There is no change in that. So that this says the economic. How with this? This much is the income, this is the expenses, and this much is the final revenue. But when it comes to pay the tax, people always bleed that I don't have the money to pay the taxes. This is what is the history of the, right or wrong? Whenever it comes to pay the taxes, I've always earned the loss. I always have the loss. So this is the final scenario. Income is this. When it comes to taxes, this is the final. Then, basis of charge. Income tax always has to be paid on income. That also remains the same, whether it is a 1961 Act or it is a 1921 Act. What are the changes? There is a structural changes. If you see, the charging and the related provisions which were scattered into the multiple sections through decades, because from 1961 to 2024, all the provisions under the Act were scattered. We had 28A, 22, 28A1, 28A2B, this are running into number of clauses and number of sections. Now they had been merged into the single sections and all. We have a tabular format which is discussed yesterday. They have been restructured and logically sequenced for a better readability. So if you see now, you read the Income Tax Act 2025, you will find everything in a structured manner. This is the basic change in the 2025 Act. Secondly, the charge on the income is always on the total income. You have to compute your total income. The heads of the income remains the same. There is no change in the income. 5 heads of income are there. That is salary, house property, capital gains, etc. There is no change in that. And the income tax, whatever income you earn. Please, there is seats over here. You can come here and sit. Seats are available here. Please come. In the front row is there. Continues to be levied on the total income. And there are no provisions relating to the residential status, and the deemed income remains unchanged. Even for this profit and gains of business, also you have to see first whether the residential status has to be changed in, and your deemed income, etc. Whether that is income is chargeable to tax. You have to first identify what is your residential status, whether it will be chargeable to tax or not, whatever is there in the 1961 Act. Similar way, on the same lines, on the same principles, there will be, it will be applicable under 2025 Act also. Clear? Then, what is the key difference between the two acts? Key difference is that you had to read 700 plus sections and 511 rules, which has been now reduced to 536 sections and 333 rules. So your rules and sections has been reduced in the new Act. Secondly, the concept of previous year and the assessment year has been now been termed as a tax year. So this year will be very crucial, that is 26-27 year. Now we have to deal as a, it will be termed as a tax year. So this year, starting from 1st April, you will be dealing with the two type of years. One will be a tax year, another will be an assessment year. So when you will be filing the returns for the financial year 25-26, you will be filing for the assessment year. But whenever you will be paying the taxes for the financial year 26-27, you will be paying the year taxes for the tax year 26-27. So while paying the taxes or doing the transactions, while selecting the transactions and all, you have to be very particular by selecting the year. You have to select the tax year correctly and the assessment year correctly. Because by mistake, if you have selected any incorrect year, because both the years are same. For paying the self-assessment tax, you have to select assessment year. For paying the assessment, say advance tax, you have to select the tax year. Both the year are 26-27 only. That will be your assessment year. This will be your tax year. So this precaution has to be taken. So this is a transitional year. So this is one change you have to remember. Then what is the term as a tax year? That is, it is both the period is 12 months only, which will start from 1st April and end on 31st March. In many countries you see, you can have a different period for income. But in India, it is defined state. India, you can have only 1 year, that is starting from 1st April to 31st of March. Then, suppose in case, if you have a set up a business or profession, which suppose the person has started or commenced a business in a between period, that is 1st July or 31st October or that, then in that case what will happen? His tax year will be from that commencement date till the 31st of March for that purpose, that business. For that business. Then, if that any source of income which comes into existence in that particular year, then for that particular source of income, that particular tax year will be, income will be the tax year. So this is the basic change for that particular business or income. So this is the change under the Board Act. Another change is definition of income, which was very disputed and debated. That is, when any person was receiving, who was in the business or profession, basically in exports, they were receiving export incentive or any type of import or export incentive, it was always debated whether it should be taken as business income or other income. Now 2025 Act clarifies that. It says that it is related to business, then it will be a part of profit and gains of business. You have to take it as a profit and gains of business only. It will not be forming a part of any. This was very debated. Many case laws are there that you have to take it. Clear? So this is the major change. Then coming to another thing, simplifications, that is redundant provisions are removed, which is what yesterday has been discussed. And whatever communication has to be done related to any filings, any related communications will be through digital mode only. No physical intervention. So this is what the Act says, clear. Core objective is to digital filing, digital communications only. So your email addresses, your phone numbers actually has to be updated. So if it is not updated, then your communications, if it's not done, goes to the wrong email address or this, then it is treated as a valid address only. So this year you have to be very careful from now. It was already earlier also. So any mail, email address, etc. If it is, whenever there is a change, you have to get it updated on your tax portal through filing the forms, necessary forms. The earlier form number 49A was there to get your PAN addresses updated. Now we have a new forms. When we come to that, that will come to cover that. Then if there is any dispute or any litigations which has there, this is there, the Act says that you will have to always adopt a this taxpayer-centric approach. That is, you have to give importance to the taxpayer and to reduce the litigation and enhance the transparency. This is what the Act says. And this Act has been made in lines with the global alignment, that is to reduce, and it accordingly it has included the digital assets and also given importance to tax the global income across the globe based on the residential status of the SSA. So these are the core objectives of the Act. Then the guiding principles why this income tax law was drafted, that is simplification. There are no more policy changes. Continuity and certainty has been maintained and no modification of the tax rate. This is all actually discussed yesterday. Now the drafting procedures are, this is also discussed yesterday. Then second thing is there, that government has says section 532, what it says that the Act has authorized the central government to frame schemes, that is to improve the efficiency, transparency and accountability. So in case government finds out that in future any scheme is required to make this Act transparent, then they can bring any scheme, they can amend it, they can modify it. Now you see that any amendment or modification, this basically says that this will be the final Act, no modification will be required. But then also the clause has been kept over here that modification may come. So reducing the taxpayer interference to technology. So technology has been given importance and the resources via economies of scales to the functional special. This is what it says by section 532. And related to TDS, when Ravi is going to cover the TDS provisions, but shortly I'll say that in TDS also there were scattered provisions. That is only last provision was 194T. Only U, V, W, X, Y, Z was remaining. Right? So now that U, V, W, X, Y, Z has been reduced, so that has been brought down into one single provision, that is 393. Ravi will cover in detail. And digital importance, digital first enforcement has been given. So everything now will be done on a digital. Digital has been given importance. The virtual digital space now has been defined over here, which was not there in the 1961 Act. Because at that time, this was not there. Now AI becoming much more importance, gaining much more importance than crypto assets, etc., gaining much more importance. So here, virtual digital space, every rule saying many spaces, many places, it has been mentioned that virtual digital space. Now what virtual digital space means? It includes digital environment such as email, cloud platforms, social media, online investment accounts, and asset related websites. So wherever the virtual digital space comes, it will include all these things. I will cover much detail in the last part of this presentation when it comes to the end, because otherwise discussion will start later, otherwise I will not be able to cover the presentation. And virtual digital assets, what it includes, that all value holding digital assets including cryptographic ledger and technology. And if there is any dispute, we had a dispute resolution scheme under the 1961 Act. It has said that a robust and a tax-friendly dispute resolution mechanism will be there under the 2025 Act. The draft income tax rules, that is which has been introduced in 2026, it is there basically streamlined and consolidated to reduce the redundancy and compliance burden. So here also there has been draft rules has been reduced and 23 new rules has been introduced. These 23 new rules is related basically for virtual digital assets and virtual digital space, because these were not there under the old Act, and we discuss when we come to that part. Faceless assessments, compliances are also covered under these rules, and the scope has been expanded that whenever there is a faceless assessment, faceless is there. So what has to be covered, how this faceless assessment has to be done, that are also included in these rules. Old tax regimes, that is against the HRA and all, when we yesterday we discussed about the schemes and all, it has been covered over there. So 511 rules reduced to 333 rules, out of which 23 rules are new. So if you see that 300 and to remove these 23 rules, so 200 rules which were old and redundant rules has been removed from the existing rules. So good now? Study less rules now. Then profit and gains of business, coming to the main topic now. So we had under the 61 Act, section 28 to section 44 DA. How many sections were there? 16, right? And here it is now 26 to 66. So increased to 46. Right or wrong? Section increased? Yes or no? Yes. How many people are there for yes and how many people are there for no? One for yes, all there are no. Why? We had in 1961 Act 35A, 35B, 35C, 35D, and endless, 32.1, 32.3, 32.4, 44A, 44DA, 44B, etc., etc., running into number of sections. And here we have 26 to 66. The list was unending. So here we have 40 sections. What are the changes and sections and provisions? The flow has been revised and the sections has been reduced. So it has been clubbed, provisions has been consolidated, and there has been introduction of tables. And wherever you see that if you want to claim any deductions, there should not be any dispute. That suppose if you want to claim any deductions, suppose in earlier IC, ATIB, this type of deductions were there, etc., or any such type of deductions where they have given you the example how you have to compute it. So this resolves your issues. So in this way it is simplified. So if they given the formula, example has been given over there. So it will be very helpful that in this way only you have to do it. So tomorrow suppose if you do it in another way, it is not acceptable. Then provisos, there were again to this, if you see the old Act, the provision, if you see the old Act, deleted. Refer to this, person was getting confused, what has to read? Applicable up to that date, applicable up to this date, applicable up to that date. a person may go mad. But here now it says this up to this date. So redundant provisions have been removed and all niche provisions have been revised. So all relocated. So till now, until the amendments come, the act is good. And only simplification leads to more complication. Coming to this, that is eliminated clause by clause references instead of broadly incorporating any sum chargeable to income tax under section 226(2)(e) within the scope of income. So whatever you have earned is your income, and that is chargeable to tax. Whether it is legal, whether it is illegal, everything is chargeable to tax. All export benefit scheme, whether remission, refund, incentive, license to sale profit, are now definitely classified as business. Any ambiguities is there, now removed everything. Everything is a part of your income under the head profit and gains of business. Then bigger changes in depreciation. We had section 32(1) in Income Tax Act 1961. New section number 33(8)(c) says that put to use was there. Here it is added first put to use. The word first is added. The main change is that first is becoming very difficult to read. First says that the addition of the first before the word put to use means the machinery must be used first for the purpose of business. So it has to be used first for the purpose of business. So this means that if the machinery is not used first for the business, the depreciation, additional depreciation may be disallowed. So now additional depreciation, because in many cases is generally is not available when you follow this, follow the new scheme, that is alternative scheme, etc. But where the old scheme has been followed, where alternate other scheme has been followed, then it cannot be available. Then about employee welfare schemes, ESIC, PF, etc. You had subsections and all. ESIC, PF was in other sections. Now it has been consolidated into one section, that is section 39 only. All has been grouped into one single section. So all employee welfare contributions have been consolidated into employee welfare expenses under a single comprehensive sections. Please note that this is applicable from 1st April 2026 for the tax year 26-27, in old assessment year 27-28, but assessment year is not there 27-28, so tax audit for the year 26-27, this will not apply. You have to do the tax audit under the old act only, not under the new act. Please remember this. Then charging sections, loan cancelled, non-compete agreement, these were certain disputed, whether that amount received, whether that amount given, etc. Then cessation of liability, that is section 41(1), new section 38. If there is any waiver or cessation of trading liability, it was taxable. That is, now in this, one more thing is added. It says that for MSME registered entities, benefit or compounding for one-time settlement with the banks excluded from deemed income if the SARFAESI is within the SARFAESI framework. Other is this thing continues, but this has been benefit has been given for the under the new act. Illegal business income, it was not there in the 61 Act. There were certain judicial pronouncement, that is illegal business is taxable, which was there, the Bharat barrel case principle was there. But here it says that explicitly codified that even if you do the illegal business, you have got the money, you have got the profit, it is chargeable to tax. But specifically said if you have earned the loss, then loss is not deductible. Then non-compete fees. Any amount received for not sharing know-how patients, copyrights, not to carry business of offense will be taxable as profit and gains of business, that is section 28(5)(a). It continues, that is taxable under the head profit and gains of business. But here's one more addition has been made here, that is extended to restrictive convenient payments for not hiring employees also. So that has been extended. Now you see these changes are there or no? So scope has gone on expanding. Then coming to rent repairs claims. That is, if any premises for which rent has been paid, what is issued? Deduction for rents, rates, repairs and insurance, where the premise is used for the business or professions, where the SSCI was owning the premises, and then only if any expenses was paid. Now it says that rent includes lease premium, paid in installments, sublease payments explicitly allowed for co-working space charges also, because now many companies are taking the premises on co-spaces. So this also they have specifically said this is allowable, because this was not there in the earlier act. At that time this was actually not there. The concept was co-space was already not there in the earlier act. At that time this was not there. Then repairs and insurance of plant and machinery, that is current repairs and insurance premium on plant and machinery used for the business was deductible. That also continues, but it says that current repairs is distinguished from the capital improvement. It says that criteria is codified that the useful lives to extension should be more than 20%. So you have to see that it fits in the correct formula, then only it will be allowable. So the formula has been given, so you have to identify within that if it fits in that formula, then only it will be it will be treated as a revenue expenditure, otherwise it will become as a capital expenditure. The most debatable thing was there whether it is a revenue or capital. Then about research and development expenditure. In research and development expenditure, this is basically especially for many companies where R&D expenditure is much more. The result comes after many years, especially in pharma industries, chemical industries, where they spend huge amount of money. And they were getting the deductions on a weighted average basis. Suppose they incur expenses 100 rupees, they were getting weighted average as 150% deduction, 125% deductions. And you had many clauses, that is section 35 dealt usually with that, 35.1, 35.1.3, 35.1.2, etc., etc. many. So they were. And suppose at some times that research they did it, but that research did not succeed and that research failed. And in pharmaceutical industry, etc., it generally happens that they do the research work, and the research sometimes the research does not succeed. They do the 10, 15 times research and only one product comes out of that. And the gestation period of that is too high. So they were given a deduction of 150%. So here it says that now only whatever you have earned, spent, that much only will be the deduction allowed. So in-house, if you do an in-house research, the deduction is now restricted to 100%, not 150%. And in some case it was 200% also. So now it is specified that what you do, if there is an in-house R&D work is done, your research will be allowed to up to 100%. Then if you get this research done through paying to any research university or association, then in that case also it was allowed as a 150% deduction. So that is also now restricted to 100%. And if any capital expenditure is done on research and development, that is section 35(2), then capital expenditure on scientific research, that is excluding land, was fully deductible in the year of expenditure. Now it says that same 100% deduction will be allowable, land explicitly excluded, but now it recognizes IP registration cost also as a scientific research expenditure. So this is the change related to R&D expenses. Then preliminary expenses, that is section 35, new section 44. It allows up to amortization up to 5 years, at 5% of the cost of project or capital employed, specified expenses qualified for the deductions. Now in the new act, the list is expanded It includes now digital incorporation cost, cyber security cost, and ESG compliance cost also. Because now this is the biggest cost. Was the country is moving toward digital, there was lot of expenses are done toward digital security and all. So this also will be a part of preliminary expenses. Then about amalgamation and demerger, that is section 35DD, old act, section 52 new act. The expenditure on amalgamation or demerger, that's 1/5 was allowable. It now covers the expenses on conversion of a company into LLP, provided section 47(3)(b) old act conditions are satisfied, which was not there under the old act. VRS, that is section 35DDA, VRS payments to employees was to equally amortize over the 5 years. Now it has clarified that even the employee contribution to NPS in lieu of VRS payment is also covered. Then expenditure on prospecting minerals, that is section 35E, new section 51, for mineral extraction, that is 1/10 over the period of 10 years. Now extending deep sea mineral prospecting for offshore energy has been included. General business expenditure, that is 37(1). When nothing is included over there, we come to last, that is 37(1), where everything is allowed, covered. Now it says that any expenditure not being capital, not covered in any section, that is 30 to 36, including wholly old expenditure for business, is not deductible, is deductible. And CSR expenditure, that is under section 135 of the Companies Act, is not deductible, which was very much disputed because many people were claiming this CSR expenditure under section 80G as a deduction. Now it says CSR non-deductibility is retained in expenditure. Additionally, expenditure on bribery, facilitation payment, and contribution to the political parties are explicitly excluded. So it has been now clarified that even if you pay this, this is explicitly excluded. It will not be allowed as a deduction. You are aware that this is to be certified in tax audit report. There is a certification from a chartered accountant in the tax audit report. Are you aware about this? This amendment has come 2 years back in the tax audit report. Anybody is aware about it? How many people have signed the tax audit report? This is our guidance note which has come with the tax audit report. In the tax audit report, you are required to certify this, whether any payment has been made for any relation to this payment. This was already there in the 1961 Act. It was already amendment was there in the Finance Act, and in the tax audit report also it was included. It was required to be reported whether any such type of payment has been made. The chartered accountant, if the is covered by the audit, tax audit, if any such payment is made, whether that has been paid in or not, there is a reporting requirement in the tax audit report. Advertisement in political party or publication. Section 37(2)(b), expenditure on advertisement in publication of political parties. Now it is extended to digital advertisement on social media platforms associated with the political. Now you see that everywhere the posters are there. मित्रांच्या भावाच्या बर्थडेच्या हार्दिक शुभेच्छा. Posters are there but never removed. Right? So even this type of advertisements which are published, that also is now been included, that is to be disallowed. Right or wrong? That is not permitted by the High Court also, but still these boards are and banners are always available. Good thing is that our people from the house are not telling that put my banner also over there, my birthday is there, my hoarding also should come, that my birthday is there, people should know this. So this type of basically now all these things which has come up from over the years, this was things has been come through case laws and as that has been included now in the Yes. So these are related to specific deductions which has been added in the law. Then about TDS defaults and disallowance. This is the biggest change in the profit and gains of business. Now 40 AIA, everybody is aware that if the TDS is not deducted, the payment is not allowed. This year one amendment is there in the tax audit, that is you are filling this 34A clause, right? Are you filling or no? Yes, tell me yes or no. What you are filling in that clause? Whatever the client is giving, you fill up and sign it and give it, right? Profit and loss debited, amount debited to profit and loss, TDS deducted, what client gives, sign and give it, right? Yes or no? Then what, are you verifying it or no? What verification you are doing it? Whether the tax is deducted properly, whether it is not deducted properly. 100% verification is done or not done? Huh? Huh? Sure. Suppose if your tax audit report is selected by the tax audit review board, and if it is found that it is not correct, or any such report is selected for scrutiny and that it goes to tax peer review board for this, then if this income tax department recommends your report to the peer tax audit review board for reviewing, then what will happen? If this is found incorrect, then what will happen? How many people have qualified that report for 34A? Or how many people have put the disclaimer for this? Nobody, right? Means everybody is silent and nobody has put. This year's tax audit report says that any payment which is made to non-resident SSC without where TDS is required to be deducted and it's not deducted has to be certified by the chartered accountant. That you have to report. This is the major amendment in the. Now we have to see whether the payment which is made to non-resident, whether tax was liable to be deducted, you have to verify it, and whether the tax has been deducted and the payment has been made. That is the duty of the auditor. That has to be verified. Now here it has been said that 40A payment to non-resident without TDS deduction is disallowed in the year of payment, allowed in the year of TDS is deposited, and 40A 30% disallowance for data. So if the payment is made to non-resident, where TDS was required to be deducted, it is not deducted, 100% disallowance. In case of resident, not deducted, 30% disallowance. Same is repeated over here. 194N, TDS default cash withdrawals, proportionate disallowance has been introduced here. In cash withdrawal, that is in 194N, TDS default was there, that is cash withdrawals, that specifically this will apply to the banks itself. When you do the bank's tax audit, 194N basically applies to the bank, where the cash withdrawals are there. Cash withdrawal, bank has to deduct the TDS, right? Right or wrong? Chalo, people are not sleeping. I thought I'm boring everybody. So now in that case, if the bank has not deducted TDS, then bank will also be liable for 40, this section 29, disallowance, that is 30% of the amount. Whether taxpayer is required to deduct it due to applicable DTA AA or not. So here you have to be very specific now. Then salary or interest to the partner, 194T. Biggest question mark. मुर्गी पहले आई या अंडा पहले आया? Because 31st by 30th of April, your partnership form is there. Partnership form, you have to deduct the TDS. And in case of partnership firm, if you are following a cash system of accounting, you don't deduct the TDS, you are not getting the deduction. A professional firm is the chartered accountant firm is there. You don't deduct the TDS, you don't get the tax, you can't get the claim. So this will be a biggest exercise this year, because you have to finalize your accounts. 30th April is you have to make the payment before 31st of March if you are following a cash system of accounting. But if you don't follow the cash mercantile system of accounting, then you have up to 30th of April to finalize. But you have to make the payment before 31st of March if you are following the cash system of accounting. A biggest joke of which has been made. The limits of 40B has been kept as same, that is 3 threshold limit, that is 30%, 60%, whatever. The first time it has been explicitly codified in the new act that LLP also has been separately mentioned over there. Earlier LLP was not there in the 1969 because at that time it was not there. Then about tax and cess paid by the company, that is 40A2, income tax, dividend distribution tax, surcharge, cess which is not deductible. Now it includes, income tax includes advance tax, self-assessment tax, reference to wealth tax has been retained for historical assessments only. Because what it was says that income tax, it was not clarified whether income tax, people were saying income tax means income tax only. Self-assessment nahi aana chahiye, ye nahi aana chahiye, nahi. But now it says that income tax includes everything. So specifically mentioned over there, they added. Then GST paid on non-business expenditure. Suppose now what happens, GST which is paid on non-business expenditure, you claim it as an expense. Right or wrong? Because other way to pay the GST on a business expenditure, you pay a claim as an input credit, that is debited to the liability account. Right or wrong? And the changes are not there in profit and gains account. Nothing, no changes are there. So this is all. Input tax credit is not claimed because that you don't get the credit because that is claimed as a business expenditure. So 40A position is applied by the CST via circular. Circular was there. Now here it is specifically said that GST paid and itself eligible credits, once you are credited, claim the credit of the income tax in the ITC, that is not allowable as an expenditure. So even in your fixed assets, any GST is included, and you have claimed that as an input tax credit, it is not allowable as an expenditure. You cannot claim as it as an expenditure because that you have claimed the credit. But if there is any block credit where the deduction is not, you cannot claim the input credit, you can claim it as an expenditure. It is specifically stated in the 2025 Act. So this is a clarification, that is you can claim section 29 allows you to claim it as an expenditure. Then cash payments, 40A3, what it says, 10,000 rupees payment, right? Threshold is kept. Rule 60D exceptions are there. Right or wrong? What rules are there? That we don't know. Rules are there, na? 40A. I think we had learned at the time of exams. I don't recollect the rules because I had passed in 1993. Thereafter I have not read the rules at all. It says that UPI and digital payments below 10,000 are not subject to disallowance even if aggregated with the cash payments to the same party on the same day. Now, UPI payments is actually not a cash payment. UPI payments, why this was required, I don't know. It specified in the Act, it says that UPI payment is not cash. Excessive payment to related party. Relatives definition, you know, yesterday relative definition was given. Now in the Act it said that whatever payment is made to relatives, if it is in excess, you are to disallow it. The auditor has to disallow in the tax audit report. That is a disallowance column has been given over there in the tax audit report. That is sister concerns, it says AO can disallow the excessive position. Now the same list of the is there continued under the section 29. Same list continues, but it says that 10% equity in case of a company, shadow directors, deemed associates under the FEMA registration is also a part of a relative under the new Act. So this is included in the 40A2 list. Then gratuity fund or provision, that is section 40A7, new section 29. Provision for gratuity is not deductible unless actually paid. That we actually know it. But same is continuing. Actually determined provisions is not deductible. Explicitly, if the gratuity insurance premium paid to LIC gratuity is deductible in the year of payment. Actually, this clarification was there, not there. This has been clarified now. Mark to market losses, 4813, section 29. So see, this all are covered under section 29. We had separate section 48.3, 48.2, 48.7, 48.13. Now it is section 29 only. Is a part of section 29. Mark to market losses or expected losses not deductible. It applies to derivatives, foreign currency exposure, commodity contracts, exceptions, hedging contracts designated as per Ind AS. Here he says that fair value changes are allowed now. Then certain deductions that is on actual payment basis. We know that we have 43B. 43B, A, B, C, D, H. What it says that 43B, A dealt with tax, duty or sum deductible on the actual payment. When we made the actual payment, at that time it was at the year end what was there. GST payable, GST was not there because this was more disputable. Whether GST we have to disclose in the tax audit report or not, always disputed. So GST liability payable to the government explicitly included retains the provision for the payments before the ITR due date. So GST, if it is outstanding and if it is paid before, then only it will be allowable now. Employer contribution to PF, ESIC or gratuity. NPS contribution is now included. Contribution by employer also covered under this clause. ESIC employers are actual payment basis. This is now included. Then bonus commission payable to employees deductible on actual payment is already always there. Now performance linked bonus, that is pay ESOPs exercised by employees, also deductible. That is included now in this list on actual payment basis, that is the exercise date. Then interest on borrowings from public financial institutions, that is scheduled banks interest, financial institutions, state financial cooperatives. Now it has been extended to this external commercial borrowings, NBFC loans, where NBFC is registered with the RBI. That has been a part of, that is included now. Payments to NBFC, this MSME, section 37. The most disputable, the most working we required it, introduced, that is 43BH, inserted from Finance Act 2023. Now it is changes here, what changes has been made here is, it says that MSME which is not registered with Udyam portal will not be considered as an MSME. So what is registered with MSME, Udyam portal, that only will be considered as MSME. This is the change. So from 1st April 2026, you have to see that MSME, this Udyam portal certificate will be required. So those SSCs who do not have the MSME certificate from Udyam portal will not be considered as a MSME. This is the change. So buyer's responsibility is to verify the MSME status to get it confirmed. Then about changes related to specific business income. Sale of import licenses. Now again, import license was one of the big debatable issues. That is MEIS scripts, then PLI production link incentives. This is all are deemed business incomes. That is sale of import licenses, cash assistance, duty drawbacks, etc. Which you have get it after you complete the exports. You get it after you complete your export formalities. Whether this has to be treated as business income or not, it says that 2025 Act says that it will be a part of your business income only. Section 26. Then subsidies or grants. Suppose if any subsidy is received, assistance in the form of subsidy, grant, cash incentive, duty drawback from the government or state government, except it is for the capital purpose, then it retains that it will be a part of your business income, but it has added certain things, that is, can sit here, spaces are there, sit here, that spaces are there. Additional carve-out as subsidies from PM, Vishwakarma scheme, startup grants from DPIT, approved incubator streams are taxable as income if the conditions are met. So conditions have been given. So if you fall within that conditions, it will be taxable as a business income. Then bad debts recovered. I think yesterday we had a good discussion on the bad debts recovered, right from 1922 Income Tax Act. Now it says that some additions are made that suppose if any foreign currency loans which are previously written off and now that has been recovered, then that also will be a part of your income. And it also clarifies that recovery from any NCLT resolution process is recovered. Then also it will be a part of the business income of that year in which it is received. Stock in trade or asset, stock in trade which is converted into the capital asset, that is section 45(2), a mirror section, section 67 of the new act. Treatment of the same, that is if the stock in trade is converted into a capital asset, then fair market value which is there on the date of conversion will be treated as a income of that year. The treatment remains the same. But what it says that the capital gains provision will apply on the eventual sales. It was not clarified there, but the clarification has been given in the 2025 Act. If there is any business reorganization, that is a sole proprietorship, please come here. Seats are there, please come here. Conversion into firm into company, not as a power form, if the conditions are met, that is section 45(4). That is, there is a reconstitution, dissolution, etc. In that case, what will happen? Suppose this is converted into a LLP, etc. Then you need to have, madam, come here, please, seats are available here. Seats are available, you can come here. Dissolution is there, the reconstitution is there, then you have to see that the computation, you have to prepare it. The conditions has to be made. There are conditions which are given under section 71. You have to follow up that condition. If it meets the criteria or the conditions which are given in the section 71, then it will not be treated as an income. It is similar to that section 45, this 47(3) for transfer which was there for the LLP on that lines. Then about real estate or joint development agreement. A biggest disputed and debatable where the dispute was arising, that is individual or HUF, a landowner, when it was entering into a joint development agreement, capital gains would arise in the year of completion certificate, not in the year of joint development agreement, and stamp duty value, share in the project, etc. plus cash received was treated as a fair value. Now that provision remains the same, but what is stated that this is extended to the firms and the companies as landowners. Finance Act 2022 amendment is there. There is anti-abuse rules where joint development is subsequently, suppose it gets cancelled, original capital's liability revives in the year of cancellation. The clarification has been given here subsequently if cancellation happens, because many times it happens, the joint development agreement gets cancelled because many disputes happens in that case. In that case, this was not there. Then in that case, the clarification has come. Then about crypto mining. Cryptocurrencies are getting much more importance now, which was not there in the address in the 1961 Act. The CBDT is also has given the informal guidance that is crypto mining is a business, income chargeable on the profit and gains of business. If incidental, it may be income from other sources provided you meet certain criteria. 30% tax, no losses allowed, etc., etc. Everything people are aware about it. Since last 2 years we are dealing with it. No losses allowed, profits straight away pay the 30% taxes, etc. But here it says that mining of virtual digital assets carried on as a business is characterized as a profit and gains of business. Cost of electricity, hardware is deductible. Transfer of mines virtual digital is still taxable under the clause is 30% straight tax you have to pay. So these earlier these expenses were specifically not allowed, no deduction of expenses allowed, but these two expenses now will be allowed under as an expense. You can claim as a expenses. Then there are two changes in the depreciation claim. That is blocks of assets. Everybody is aware that on intangible assets, goodwill, etc., you cannot claim the depreciation. That is intangible assets. 34, section 32, section 43(6) under the old act, new section 33 and 39. Block of assets, now you have to segregate the blocks. Separate blocks will be there for intangible assets, and for them, goodwill also will be having a separate block. Because it was very much disputed whenever there was software also is considered as a intangible assets. And many cases it was found that depreciation was also not being allowable in such case. So now we will be having two separate blocks wherein goodwill is will be now a separate block. Half year, that is if the asset has been put for use for less than 182 days, again the retention is same, you will be getting the 50% deductions. But first put to use criteria has to be seen now for claiming the additional depreciation, that you have to need to remember, because this you have to certify it that whether the SSE is eligible to claim the additional depreciation, means that the commercially deployed has to be seen, and trial run will be treated as used count to use. So this is specially treated, given that if the machine has been used for the trial run, it will be treated as a for the purpose of business use. Secondly, about unabsorbed depreciation, the rules remains the same, that is unabsorbed depreciations can be carried forward indefinitely, no time limit, can be set off against any head of income. Same rules follow. MAT computation under 115 JB, unabsorbed depreciation continues to be considered lower of depreciation or loss forward, subject to MAT, whether it's allowable or not allowable, that is separate thing. But here, for computation purpose, it is allowable. Then about tea or rubber, coffee rubber account, that is about deposits, that is up to 6 months lower of profit. Now in that case, site restoration funds, that is deposits for petroleum extraction business, has been included over there. Then priority sectors about incentive related deductions, that is ATIA, ATIA, 10AA, ATIAC, ATLA. These all sections now become sections 138. That is ATIA becomes 138 sections, where the companies are into the infrastructure business. Therein the criteria is that you have to get these accounts audited and the return has to be filed in time, then only you are eligible for deductions. It remains the same, criteria remains the same, there is no change in that. Infrastructure development companies, power generation, transmission companies, they are clubbed into one section, that is 138, 100% deductions for include for the 10 years. SEZ units are retained, sunset clause extended to 1st April in the ITA 2025. Renewable energy plants, there is solar, wind, hydro eligible, battery storage systems are added as eligible infrastructure. These changes are there. Then SEZ units, that is section 10AA, now new section 19. In that case, the eligible SSE, that is approved SEZ unit, which are established before 31st March 2020, the deductions remain the same, that is sunset for new units, March 31, 2020, no extension is there. All the privilege will continue. Startups mandatorily required to be registered with DPIT, ATIAC section 145 new. You have to register with the DPIT. Conditions remains the same. Then in that case, you are required to get this certificate of DPIT, startup registrations, incorporation window, extended to up till 1st April 30, continues in new act. Then about payment to banks, small finance banks are included in the section 147, the new act. Then Gift City has been included in this. A 10-year tax window is there. Then about affordable housing project, 80 by IBA, now section new 142, developer undertaking affordable housing project continues. The carpet area restrictions are there. That also continues. This is extended in new act also. The new employment generation scheme, 80 JJA, all SSEs, 30% employee cost for new 3 years, etc. This all remains scheme. Then patent and royalties, that is IP is also included now. That is 10% tax on the royalty income from operation will be allowed as a deductions, R&D linkage scheme. So those who are eligible, they can claim. Coming to the presumptive tax, there are certain changes under the presumptive tax. That is, other changes remains the same, that is business, that is 44 AD and 44 ADA. Now 44 AD and 44 ADA, you don't have to remember same, now only that becomes section 58. Section 58 is now this presumptive tax. Other things remains the same. 8% turnover in case of business, in 6% of the profits of the in case of digital business, and 50% of the gross receipts as deemed profit in case of profession, etc. That all other things remains the same. Notified professionals, the notified professional list has been expanded. The list is available on the portal. You can refer to the list, which professionals are covered, which professions are covered, you can refer to the list under the 58 Act, section 58. And this 44 applicable to all professionals notified under section 44AA, not limited to specific professionals. So professional definition has been expanded. Then coming to other presumptive tax summary, that is good carriage. We had that is owning more than 10, less than 10 vehicles. You have to pay that 100,000 rupees per ton per month, 7,000 per ton. That is continues here also. There is no change. Shipping company, no change. But what it says is corresponding TDS under section 172 has been retained. Aircraft for the foreign companies who are doing the aircraft business, which has been introduced under the Finance Act 2025, that continues here, provided the conditions are met and DTAA amendments, DTDA benefits are codified. Turnkey projects extended to infrastructure projects, DPIT registration. Then exploration of mineral oil, technical services, life insurance business also remains the unchanged to domestic. One biggest change which is there is that new provision, that is clause 54, says that when a SSC opts out from presumptive tax, that is there that once you have gotten into the presumptive tax, you have to be in there for the 5 years. And once you are out, you cannot get in after, for the period. Now it says that here, the change what has happened, he is required to maintain the, once you are opted out, you are required to maintain the books of accounts and get the tax audit done regardless of the turnover for a period of 5 years. So whatever your turnover is there, once you have opted out, you will have to get your books of accounts audited for the 5 years, eliminating the practice of rotating in and out of the presumptive taxation. So this is the change which is there in the this presumptive taxation. Another change which is there, that is, if you have adopted the presumptive taxation, if your profits in the books are higher than what is there, suppose if your profit is 8%, they are showing the profit in the 8%, your books of accounts shows the higher profit, you will have to take the higher profit, not the 8% profit. That also is there. Then maintenance of books of accounts. Maintenance of books of accounts has been made mandatory to all SSCs. That is 44AA said that you have required to maintain the books of account. The condition in the old act was that professions, that is specified professional, that is legal, medical, engineering, etc., maintain the prescribed if the gross receipts exceeds rupees 1.5 lakhs in the 3 preceding years or in the first year. Other business income more than 1.2 lakhs or 10 lakhs exceeding year. Here it says that thresholds limit for specified profession is 1.5 lakhs. If your income in the case of a professional exceeds rupees 1.5 lakhs, you are required to maintain the books of accounts. Other business, it is increased to 2.5 lakhs income or 25 lakhs of turnover because inflation has increased. You are required to maintain the books of accounts. And the books of accounts can be maintained on the accounting software. Digital records explicitly recognized as a books of accounts. You can have the books of accounts on a digitally. And one condition is there, it is stated that the digital accounts, if it is maintained, the books of accounts should be available in India for verification. And when it is said to be maintained, that whenever it is required, it should be in the same form when it was presented for at the time of the filing. So as per the Income Information Act, IT Act 2020, it has given what will be the, how it has to be maintained. So you need to, when the accounts have been maintained digitally, you also have to take into consideration the Information Act 2020. Then about what should be the prescribed books of accounts. Rule 6F, for the professional, it said that you have what type of books of accounts you are required to maintain. And for other businessmen, books of accounts were not specified. 6F now says that rule number 24. It says that now addition of audit trail in the accounting software is mandated in lines of the Companies Act 2013. That is rule 11G of the provisions, digital backup is required. So digital backup will be required. I am not talking about the tax audit for the tax year 26-27. When Sikandar will arrange the meeting for tax audit for 26-27 in September or October, when this tax audit will for this assessment year 25-26 will get 26-27 will get over. At that time we'll discuss much in detail how we will cope up with this. Then tax audit for 44AB. We have tax audit form number 3CA, 3CB, chartered accountant tax audit who has to be there, do this tax audit. Tax audit limits are retained. There is no change in the tax audit limit as of now. As of now, there is no change in the tax audit limit. Under the Income Tax Act 1961, same remains under the 2025 Act. It has to be audited by the CA. Provisions of filing the audit report in case of predecessor and successor scenarios are also clarified. Suppose if the previous auditor has changed, previous auditor is not available, successor is there, the changes are also clarified in the 2025 Act. Due date of the tax audit report remains the same under 2025 Act. Explicitly provide that audit report must be furnished along with the ITR or before the ITR filing. See, it says that before the ITR filing. Suppose if you have filed the ITR before the due date and you have not filed the tax audit report, due date is not there. Due date is 31st of October. Suppose 30th of September. You have filed your ITR on 31st of July, but you have forgot to file the ITR audit report and you have filed subsequently. Whether the penalty can be levied or not is a question. It says that, law says that you have to file the return on or before the filing of ITR. It is not saying that on or before the due date. It is saying on or before the date of filing the ITR. So if you have filed the ITR and not submitted the audit report, the penalty for non-audit can be levied. Then 271B for penalty for non-submission of audit report was 1.50 lakhs, that or lower of 0.5% or of the turnover or gross received, maximum 1.50 lakhs. But because of inflation, that also has been doubled to 3 lakhs rupees, maximum up to 3 lakhs rupees. And shortly what it is stated that this penalty will be converted into a late fee. So it will be converted into a late fee. So forms of tax audit, you have Right now we have 3CA, 3CB, 3CD, right? So there we will be having only one single form, form number 56 as a tax audit covered in a single form of form. Form number 56 will be a tax audit report in the tax year 26-27. So this is related to tax audit provisions, book maintenance of books of account and tax audit. Then coming to domestic transfer pricing, only 4 changes are there. That is threshold domestic transfer pricing limit, which was 20 crores, has been increased to 30 crores due to inflation under the new act. That is 92BA, section 29. That is when you do the audit in tax year 26-27 tax year, if domestic transfer pricing will be applicable if your transactions exceed 30 crores. Arm length prices method, there were 5 prescribed methods under the 61 Act, that is cost plus method, etc., etc. 5 methods were there. These methods remains the same, but CBDT has been given the express power to introduce new methods under the 2025 Act. Transfer pricing officer under 92CA, AO may refer to the cases to the transfer pricing officer and has the current had the powers to survey, summons, etc. This remains the same, but the approach has been in case of high risk cases, that is in case of intercompany services, royalties, guarantees, mandatory will be referred to the transfer pricing officer. Then we have advanced pricing agreements. In such a case, that is this were valid for a period of 5 years in the 1961 Act with a rollback for the 4 preceding years. Now this transaction limit, a simplified process is there, that is for exceeding transaction of 250 crores. A bilateral APA processing time has been reduced from 24 to 18 months. This is the changes in transfer pricing. So these are the key differences, that is we covered depreciation, we covered goodwill depreciation, presumptive taxation, presumptive, etc., MSME payment, R&D weightage, tax audit penalty. This is just for your reference purposes. What is the summary of? This much are the 11 are the main changes of the profits and gains of business. Then everything done. Suppose there is anti-avoidance. Suppose any income which was chargeable to tax and not been charged. Then what happens? GAR rules are made applicable. The GAR rules have been retained in 2025 Act. You have multilateral instrument on DTDA codified. So both has been clarified, both has been applied simultaneously. So there is a thin line capitalization between. So EBTIA, accounting standards, carry forward disallowed, etc. This all remains business connection, deemed residency foreign, angel tax, everything has been clarified based on the lines of 1961 Act. POEM rules are there, SEP is there, remains the same. Then about profit and gains, that is section 35, the TDS. This is the biggest change. That is, TDS must be paid during the same year, making this provision substantially more restrictive than the TDS related deduction. Suppose if you make any payment to non-resident salaried employees, you have to deduct the TDS in the same year. If you don't deduct the TDS and make the payment in the same year, that expenses will not be allowed as a deduction. You cannot claim that expenses. This is the biggest change. Any non-resident employee you have on your payroll and you don't deduct the TDS and make the payment, you cannot claim that amount as an expenses. Then this is about 43B, that is new payment, section 37. That is, when you make the payment, you are required to give the evidence of payment. Like suppose you have made the payment for bonus which is outstanding as on 31st of March at the year end, you are required to give the supporting payments for that. So here you will have the payment of evidence has been removed. Now we say that you have to give evidence, that is basically evidence in the sense that you will require, the person will require to prove that the payment is been made. Then if the income of gross exceeds the threshold, mandatory books of accounts has to be maintained. The requirements vary based on the business nature, taxpayer category, and whether the presumptive tax has been utilized. And now coming to this virtual digital assets. Now it says that computer system, that is section 261E, virtual digital space, that is 261J, assets has been defined. Assets, suppose if there is a search and seizure, which will now include money, bullion, jewelry, physical, will include now virtual digital assets. Virtual digital assets, we already discussed what is virtual digital assets. Valuable articles of property, holdings in both and physical form. Now you see virtual digital assets includes everything. They can access your email, they can access your all social virtual platforms, everything has been included. Now let us see how it will be implemented in the near future. Then about draft rules. Whatever this new 23 rules has been inserted under the Act. That is, suppose if any manufacturing company wants to set up a business and wants to adopt, it is electronic manufacturing company, wants to adopt for presumptive tax, then they will be required to, certain conditions are to be fulfilled for a resident company. The list of the conditions have been given under rule number 45. Then about furnishing the audit report. As you require that certain deductions you claim it, that is ICAI, such deductions were there, then you are required to give the audit reports. So in that audit report, without submission of that audit report, you cannot claim that deductions. And for that report submissions, there are certain conditions. The furnishing of audit report, that is section 46, 138, 139, 140, 141, 142, these are the sections where capital expenditure related deductions are there. The details regarding furnishing the audit report, the rules have been specified in clause number 66. Then about arm length price, that is how to exercise the options for determination of the arm length price for multiple years, is been given in clause number 82. And about the safe harbor rules, that is those who are under information technology services and they want to follow the safe harbor rules, and for them the details are given in rule number 91. Coming to this, about now what is the definition of accountant. The definition of accountant under Income Tax Act 2025 has defined the accountant. That is who can do the valuation under the Income Tax Act 2025. Old rule was there, 11 UB. It has restricted the person who can do the valuations because he has to get the valuer certificate, they have to do the valuer course, etc., etc. This requirement was there. But now it says that, say who can be if a person is an individual, then based on experience and annual receipts, can become a valuer. That is, he should have a 10 years experience and annual receipt should be more than 50 lakhs, then he can become a valuer, for he can do the valuation business. He can become a valuer. Then, if it is an entity or a firm or a partner, then his presence in the domestic or international market, if he is in domestic, then no specific limit is there. In international, more than 2 countries he should be there, but annual receipt should be more than 3 crores in the preceding year. Then he can become a valuer. So this is what the new rule says, rule number 10. Then, aggregation of income. This more discussed yesterday in more detail. That is any sum, suppose if there is any sum which is found which is credited in the books of accounts, may be charged to the income, and if no explanation shall be charged to the income tax, that is discussed yesterday, and maybe and shall be, I'll skip this because it's discussed yesterday. and maybe and shall be. Coming to this, amount borrowed or repaid through negotiable instrument or hundi. Because there is one clause in the tax audit or report also, right? Any amount borrowed through hundi and all. Now it says, new law says that any amount including interest thereof is borrowed or repaid through a hundi or a non-negotiable instrument, a hundi, otherwise than account pay check or through any mode, as the specified by the board, the amounts of borrowed or repaid shall be deemed to be the income of the person. So this is what the changes has been. That is old law 69D, new law section 106. Aggregation of income. That is section 102 to section 105. Any unexplained credits, investment expenditure will be mandatory the income of the SSC. That is unexplained credit, which has been discussed yesterday. That is 60% of the tax, 25% surcharge and profits. This all details or documents, what you can, if you want to learn the Income Tax Act, you can get it from our institute's portal, that is e-Sahitya, which is there. Then about tabular matching of the sections, we have a compiled booklet. In that compiled booklet, you will get first tabular matching of the section, then you will get the Income Tax Act, and corresponding with the section to section, what is the difference between both the acts. You can get the comparison. Then about full Income Tax Act, you can go on the Income Tax website, and utility of the differences between what is the changes in the sections, you can go to the Income Tax portal, wherein you can click to the link and get the differences between the section. And we have our institute's GPT website. On that, any detail related to your Income Tax Act 2025, you can just go to the Direct Tax Committee's chat GPT, and you put any question related to any income tax related change to Act 25, you will be able to get all the details on the chat GPT of the Direct Tax Committee. So this is basically related to this. But what is this? A CA does not know how much he should be thankful unless he applies, he becomes adapted to the new Act. But thing is that Act will be replaced, our commitment cannot be replaced anyway. Act always has the alternative systems, but we are bound by the restrictions. Our job is always thankless. Thank you very much. I tried my level best to explain it in a better way, but...
Okay. Thank you, Avinash Bhai. Any questions?
Any questions are there? I can take it up.
Members, please be seated. The snacks are not ready yet.
see, basically when you are claiming any expenses, see, when you have claimed the GST under the GST Act, you cannot claim that again as an expenses because you have already claimed as an input credit. So that is clear, because that cannot be as again you can claim it as an expenses. So if there is a block credit, then that is not an allowable as an expenses. So that you can claim it under the GST Act. That is not available as an input credit, so that you can claim it as an expenses under the Income Tax Act. Yeah, you can claim that GST as an expense. No? So that clarification was not there in the 1961 Act. They have given it as that that can be claimed as an expenses. Yes, they were clarified. No? Depends on the key managerial person or the involvement what is there. Suppose if any incrimination documents has been found, anything which has been found to that, so that they can be brought into. Suppose if you are a key managerial person, or if any person which is associated, or any documents which are found, the documents are found which relates to your, then they can bring that person into search, and they can go through that extent, to that extent. Fine. Thank you very much.
Thank you, Avinash Bhai. You have taken the subject by comparing the old act with the new act in a more efficient manner. Now I request Sikandar Yadav to propose a well-deserved vote of thanks.
Thank you, Vijay sir. It is a great privilege and honor to propose well-deserved vote of thanks to today's speaker, C. Avinash Ravani sir. He has explained the topic in detailed manner, explaining and comparing the new tax laws with the old one. He has presented a topic in a detailed manner with explanation. Even the PPT was very insightful with lots of charts and diagrams. As it is said, the Income Tax Act 2025 is not just a change in section, but a shift in perspective. A meaningful change reduces confusion. Hope this act serves its purpose. Thank you once again, Avinash sir. Now I request members for a loud applause. We'll have 20 minutes break.